So that's weird. The price of bonds jumped today. Why would that be when the Fed raises interest rates by 50 basis points? I'm hoping you're not new to this channel, my friends, because I've only been talked about this 1,000 times a Sunday. When the Fed announces, as they did today, people have already got the numbers on that they're banking on from what the Fed said previously. So the Fed said previously, and been making noise about it, we expect a 50 basis point increase of the Fed funds rate today in May. They said that a 25 basis point increase in the Fed funds rate in March. So we're pricing the Fed funds rate now, was it 1%, 100 basis points? And when that happened, and the Fed was kind of dovishly hawkish, if you will, like military intelligence, jumbo shrimp, they said it didn't make people worry, like, oh my goodness, they're going to raise it to 3.75, like Bullard said at the St. Louis Fed or some other Federal Reserve president say. So everyone's like, oh, okay. All right, that's it. We already priced that in. Thus, let's go back to buying bonds now because the interest rates are much higher now, over 3% than they were a couple weeks ago. So we're locking in a higher interest rate with the same amount of risk. Actually, a little bit less risk because we're that much closer to maturity date. I mean, so watch the price of bonds, your bond portfolio, start ticking up. Look, I get there's a lot of rookies out there. I get it. I get there's a lot of fear mongers out there. On YouTube I'm talking about, not my audience. I get it. A lot of these people just haven't been around long enough to be able to establish any kind of perspective, as I always say. I should change my YouTube channel to Heritage Wealth Perspective. That's what I should call it. Perspective, my friends. This has been telegraphed since day one. And as such, one of the reasons I got into Wellington is because I expect bonds to rise quite a bit over the next probably 18 months or so, actually. Because the price hikes, or the price declines has already been priced into it, unless the Fed comes out with something more drastic, and there's no way they're going to do that with a negative GDP in Q1 that says, oh, we're really going to hike them now because inflation's really through the roof. And how you know that is because, whoa. We have negative GDP, all right? Negative GDP for one quarter so far. We're into the second quarter, and I can almost assure you there can be negative GDP for the second quarter, thus recession. If the Fed continues to hike in a recession, that is just mind-bogglingly stupid. Now, they might hike a little bit, just to save face, kind of like the CDC saving face by asking Sniffy Joe to appeal the decision of masks on airplanes. But no one's going to, I mean, if you're still taking the CDC seriously, I don't know what to tell you. If you're still taking the Fed seriously, I don't know what to tell you either. I mean, the whole point was Paul Volcker saved the world. So freaking stupid, man. Paul Volcker. If it weren't for him, we'd all be speaking Mandarin now, or Japanese. I guess Japanese was the issue of the day back then. Freaking idiots, man. Stupid. But look, I fell for it too for many years. So I say idiots because I'm a graybeard. I've had a chance to think this through and do some research and recognize Paul Volcker didn't say crap. Anyway, so and the reason we're gonna have negative GDP, I assume, is simple. If exports or imports, I should say, were the difference between the two, caused, I think Brian Westbury said it caused a 3.6% decline in overall GDP. So if GDP is up by 2 and exports over imports over exports are 3.6, that means you have a negative GDP. You take 3.6, subtract by 2. Hey, puppy! Gorgeous little dog, yeah. And that would give, so anyway, we got a 3.6% negative exports over imports, all right? And that's the trade account deficit. And then you have a GDP of 2%. Before you take that into consideration, you take 3.6, subtract 2, you got a negative 1.6 GDP. All right. So what just came out today? Oh, exports were up 17 billion over the last, I think he said last quarter. I can't remember the last quarter, last month. Imports, though, were up 27 billion. Much higher than expectations were. Exports were good, 17 billion. Imports, though, were incredibly high. And the reason for that, of course, is why? Oh, strong dollar. All right. So now we see the interest rates going down because prices on the bonds are going up. What does that also do for the dollar? Yeah, it makes it stronger as well. And so we're going to have a stronger dollar now too, which is going to increase imports, and exports relative to the imports will still be in the negative, which is going to hurt GDP. And as such, we're going to be in a two-quarter decline in GDP. That is a recession. You heard it here first. Let's say May 4th, something like that. Wait till, I guess, the third week of July, something like that is when they'll come out with the, maybe third week in August. That's when we'll know that we're in a recession right now. I mean, by then, it's anyone's game what happens. Guessing what happens after that. But anyway, the point being, they're not going to keep raising. I mean, again, anything could happen. I'm just saying. The odds would say, at least according to my perspective, the Fed raising rates while in a recession is pure idiotic. Now, look, we're talking about these bureaucrats. These are just bureaucrats with economics degrees. They think they're all that in a bag of chips. They don't know their butts from a hole in the ground. Yeah, they can do econometrics. Yeah, they can do some nice fancy math. Doesn't mean anything, man. Hey, just because they can do math and nice econometrics doesn't mean they know how the economy runs any better than you and I. As much as I don't like Bill Buckley, one of the things he always said, which I did like, I'd rather be run by the first 200 names in the Boston phone book than the 200 professors at Harvard. Could not agree more with that. But I'm an economist. I knew Paul Samuelson. I stood shoulder to shoulder with Paul Volcker. I think Paul Volcker is like 6'8", a tall guy, intimidating guy. So everyone's like, oh, Paul Volcker. He's tall. He's a man's man, and he saved us. I got no animus towards Paul Volcker. But at the end of the day, these guys are all wrong. 100%. Have I been wrong? Sure. But no one's going around spouting my wrongness, say, look at this guy, Josh, man. He's so smart. But they are doing it about Volcker. And even Reagan. For Reagan, we'd still be in a recession today. And I can't stand that crap either. Reagan doesn't create a job. What Reagan did was set the path for entrepreneurship to say, hey, it's okay to take risks. It's okay to be a capitalist. Unfortunately, Reagan also set the path for LBOs, leveraged buyout, massive amounts of debt and leverage. That came under Reagan too. So the corporatist types of the U.S. Chamber of Commerce won out over the Main Street types of entrepreneurs. That's just a fact, and here we are today. Anyway, so for those of you who are waiting for the bond market to drop off a cliff today because the Fed actually raised rates, watch and learn, baby. I'm here for you. I am here for you. And before you start doubting me, take a chill, think about it a little bit, say, if they're already announcing this, I think it's March 16th, if memory serves, and you can see the prices decline from then, and now you see the prices go up, and the corollary of that, of course, you can see the interest rates go up, and say you see the interest rates go down. It's interesting stuff. I will see you.